Welcome to The Explainer. Today, we're going to break down a huge shakeup to the UAE's tax system that's hitting in 2026.
Okay, so if you're an entrepreneur or a manager in the Emirates, you're going to want to pay close attention. This isn't just some minor update. We're talking about a major shift that's going to hit your operations and, yeah, your bottom line.
Mark your calendars, because on January 1st, 2026, the rulebook for value-added tax, VAT, is getting a serious rewrite. And trust me, this is way more than just a little tweak.
So, new laws are rolling out, and they bring 3 massive changes that you just can't afford to ignore. The goal here is to modernize the whole system, but it also means some new responsibilities are landing right on your plate.
All right, here's the breakdown. First, there's a new deadline for getting your VAT refunds. Second, the rules for checking up on your suppliers are getting way stricter. And third, there's actually a little simplification in there to make things easier. It's all about making the system more efficient and transparent.
Okay, first up, let's dive into the big one, getting your money back from the Federal Tax Authority, the FTA. This is huge, especially for your company's cash flow.
5 years. That's the new magic number you need to remember. Starting January 1st, 2026, you've got exactly 5 years from the end of a tax period to claim any VAT refunds you're owed. And listen, if you miss that window, that money's gone for good.
So, what are we even talking about here? It's something called excess recoverable input tax. Look, in simple terms, it's your money. It's the VAT you paid on business expenses that you have every right to get back. But this new law starts a very real, very firm 5-year ticking clock on claiming it.
Okay, but what about the credits you already have? That's the big question, right? For any established business, you might be wondering, what happens to all those old, unclaimed VAT credits just sitting on my books? Are they just gone?
Well, you can breathe a little easier, because the answer is no. Thankfully, the law gives everyone a 1-year grace period. So, if your 5-year window is already closed, or if it's going to close sometime in 2026, you get this extra bit of time.
December 31st, 2026. Put a big red circle around that date on your calendar. Seriously, that is the absolute final no more chances deadline to submit those older refund claims. The day after, that grace period slams shut. So what's the takeaway? You gotta act now. Here's your game plan. It's a simple 3-step process. 1. Review all your old VAT filings. 2. Pinpoint any of that unclaimed cash. And 3. Get those refund claims submitted before that grace period disappears. It's really the only way to make sure you don't leave money on the table.
All right, let's move on to the second huge change. This one's not about deadlines. It's about your new compliance burden. The rules now seriously ramp up your responsibility for what goes on in your supply chain. And honestly, this is going to require a fundamental shift in how you do things.
Yeah, this quote really hits the nail on the head. From now on, you're expected to do your homework on your suppliers, proper due diligence, before you even think about claiming input tax from their invoices. The burden of proof, it's shifting right over to you.
And the difference in practice is just massive. In the old days, a valid tax invoice was pretty much all you needed. But the new way? The FTA can flat out deny your claim if your supplier gets caught for tax evasion and they think you should have known about it. What does that mean? It means you need a rock-solid, formal process for vetting your business partners.
And believe me, the risks of getting this wrong are very, very real. Just look at this table. Simple mistakes, things like bad record keeping or not doing that due diligence, can lead to some painful financial penalties. We're talking 5,000 dirhams for every single incorrect invoice. Ouch.
But hey, it's not all doom and gloom. There is one simplification that's actually pretty great. The rule that made you create a self-invoice for imported services, it's gone. This was part of that tricky reverse charge mechanism, and getting rid of this one step is going to cut down on your admin headaches for sure.
So to really get why these changes are such a big deal, it helps to take a step back. Let's do a super quick refresher on the basics of the UAE VAT system.
That is still pretty new here in the UAE. It was only introduced back in 2018. The last few years have really just been about businesses getting the hang of it. So these 2026 changes, they're really the system's first major evolution. It's a sign that it's growing up.
And this number, 375,000 dirhams, this is the bedrock of the whole system. It's the mandatory registration threshold. If your annual taxable supplies and imports go over this amount, you have to register for VAT. No ifs, ands, or buts. It's basically your ticket into the world of VAT compliance.
And once you're in the system, Everything, and I mean everything, comes down to how you classify your supplies. Is it standard rated, zero rated, exempt, or completely out of scope? Getting this right on every single transaction is, without a doubt, the foundation of being compliant.
Okay, finally, let's look to the future. What's the next big thing on the horizon for UAE tax? Well, it's the move to mandatory e-invoicing. This is definitely coming, and it's all part of this bigger digital transformation.
Now this is super important to understand. An e-invoice is not just a PDF you email to someone. We're talking about a total shift away from pictures of invoices to structured, machine-readable data. The idea is to automate tax reporting by zapping that invoice data straight to the FTA almost in real time.
And the Ministry of Finance has some pretty clear goals with this whole thing. They want a more transparent and efficient economy, right? But for you, the cool part is that it could make compliance way easier. Imagine your VAT returns getting pre-populated with data straight from your e-invoices. That's the endgame. So when you put it all together, the 2026 rule changes and this coming wave of e-invoicing, it's pretty clear where things are headed. Proactive, real-time tax compliance isn't just a good idea anymore. It's the new standard. So is your business ready? The takeaway is simple. The time to get ready is right now. You need to review your systems, chase down those old refunds before the deadline hits, and get that supplier verification process locked down. Honestly, the health of your business really depends on it.